Good afternoon, happy Wednesday. Welcome to another edition of #AskRobco. Super excited today because we have a great special guest. We have Mr. Marcus Dixon with us on the show, and he is the head of research and data analysis from Lonres. Lonres, for those of you who don't know, he's going to give an intro, is a key partner to us at MJ Group in terms of providing live intel, up-to-date data and analysis of the residential marketplace, mostly London and surrounding areas, and we work alongside them very closely. So I'm very excited to have Marcus with us. He has a great insight in both what's happening on the ground now and a great track record, historically working at Savills and being with Lonres over the last few years. Great knowledge, great experience, great insight. You know how the show works. You've got the questions tab on the right-hand side. You write the questions and we will give you the answers. We've got Dan in the background running the show. We've got James with us again this week. We have some great subject matters to discuss, so please get your questions through. Great updates on the RICS market uncertainty if you've got more questions about that. Updates on Help to Buy and the extension, commercial property and residential property planning changes, stamp duty, new products in the pricing market, and transactions going through. So all of that we're going to discuss today. You get your questions through, we will give you the answers. I'm going to hand you over to Marcus to give us a bit of an intro. Welcome, Marcus. Thanks for being with us.
Thanks, Rob. Hopefully you can all hear me okay. Just wanted to give you a bit of an idea of, for those of you who don't know me, of sort of who I am and what I do and why Lonres data is sort of worth paying attention to. So as Rob was saying, I've worked in sort of the research and sort of residential analysis business for almost 18 years now, previously with Savills and with Lonres for the past 5 years. Lonres as a business was set up in 2000, the main aim being that it was an online portal for property professionals. So this is not consumer facing, this is just for business to business, and what it enables them to do is list all of the properties that they have on the market, either to sale or to let, which we then track throughout the whole process to the end, whether that be because it's withdrawn, sold or let. The reason why agents use Lonres is because they can do deals within the platform. But from a data point of view, where it becomes most interesting is that we have really immediate information on what's happening in the central London property market. So for those of you who use some of the government statistics, so for example, Land Registry, it can take up to 3 months for a sale to appear. And even when it does appear, the information that you get on that particular property is relatively limited. Whereas we pretty much know what's happened to that property within 24 hours of a change of status. So in theory, I could tell you every property that changed hands yesterday, for example. So it gives really immediate information. And for a fast moving market like prime central London, that's really important because a 3-month delay, you can almost miss a whole mini cycle. So it's fantastic information. We provide all of the data for the Coutts Prime London Index, so all of the pricing data is provided to Coutts for that, and we provide data to the Bank of England, as well as talking to a number of sort of various news outlets and giving them idea what's happening in the market. So happy to answer any questions later on about the data, but I know that there's a lot of you keen to ask some questions, so I will hand back to Rob, who I think probably has a few stacked up ready for us to answer.
Brilliant, thanks for that. Great intro, Marcus. Yeah, without question, Lonres within prime, super prime is the leading analytics and data provider from the agency perspective, both in sales and lettings, and we work alongside them and with them. As you know, every week we give you our sales stats and data. We incorporate all of the data that there is in the market and throw it in with the work that we're working on. And I think that's where we're going to start, because it's going to segment, nice segue into what Marcus is going to bring. So if we go to handout number 5, and let's just look at the stats for the last week. So if you go to the handout column on the right hand side, you'll see the latest stats. If you're on audio, obviously I can send it to you afterwards. What are the key points that we're seeing in the trend? If you remember, over the last 2 weeks, we were seeing pretty much record volume of new instructions coming on stream, if you're going to look at maybe the last 4 or 5 years. And what we're seeing now is they're converting from instructions to under offers. So if you look at your column week 29 and you look at the third or fourth column in, which is under offer, you will see the number 478. That is the big number. That's the number of properties that have gone under offer, and that is the largest number that we've seen in quite a few years. And that is a perfect repercussion of having all of that supply come on stream with the new instructions. And what we're looking to see now, and as I said last week and the week before, the true guide and the true understanding of where we're going to be sitting is when those under offers turn into sales. We need them as valuers. We need the comparable evidence. We need the live evidence. We need them to go from instruction to under offer to sell. The sales numbers are reasonably good. They're quite consistent, but on the back of the volume of the under offers, we expect in the coming 3, 4, 5 weeks for those under offers to convert into sales, and we're going to see an upturn in sales, which is going to be very positive for the market. What's your view on that, Marcus? And maybe what can you tell us in more detail?
Yeah, I mean, I agree. Is that, you know, we're in a very sort of unique position at the moment, because the transactions data that we use, so we base our transactions data on exchange date. So it's the date that you exchange contracts and you get to sort of the point of no return in terms of of putting your deposit down, and that sale is pretty much guaranteed to go through. The difficulty that we've got in using that data at the moment is because during lockdown, very little was happening on new deals. So deals that had started before were still progressing, but actually very little happened, and we saw under offer volumes during lockdown go down for sales by in excess of 80%. And so we're at the moment, we are seeing the result of that real lack of under offer during lockdown moving through the system. And just to give you an idea, running the average number of days between the date of property, an offer is accepted on a property, and the date it exchanges is somewhere between 60 and 70 days. So really, you're talking about a 2-month lag in terms of the sold transactions data, and that's obviously what we're seeing at the moment. So if you're just looking at the sales data, it does look a little bit depressing. You know, I ran it this morning, and for transaction volumes in July so far, for sales we're about 30% down on last year. But you've got to remember that was properties that were going under offer 2 or 3 months ago, so it's not a surprise at all. And you're completely right, Rob, to just concentrate actually on that under offer data, because I think that it really gives you an idea of the people that at the moment who are willing to do deals, and it's really improved. I mean, we've started to see, you know, real positive growth in that, certainly in June and very much so in July. And against what is normally a bit of a slowdown at this time of year, because it's normally the time schools break up, everyone goes on holiday, but the market's a lot busier, partly because of that pent-up demand that built over lockdown. So, you know, I completely agree. It's looking pretty positive, and we're expecting that those transaction volumes in sort of the latter part of August into September, October are going to be pretty impressive.
Yeah. I think the key point is the conversion of those under offers to sales completions. And obviously we're very, very live with the agents. We're doing valuations on a daily basis. We're seeing those properties that have gone under offer and looking to push for exchange, obviously working with all of the conveyancers as well. The agents are inundated, properties are going under offer, again, at large volume, conveyancing, valuers are pushing everything through. Everything is happening at a good volume and a good level. And now we're just waiting that 3-4 week period for them to convert. And I'm really excited to see those numbers. James, questions or thoughts on that specific area?
Yes, thank you for that, Marcus. So I wanted to highlight a couple of points there. Just the immediate updates on transactions, which we get from Lonres, is absolutely crucial from someone that works on the ground and undertakes surveys every day. Those sort of early transactions after and some during lockdown provides us crucial information on sort of market indicators and what was happening, how the market was moving, whether there was any sort of price reductions from the normal levels, and that data was completely invaluable. And just wanted to add, like you say, the sort of delay from exchange to completion could be anything from a month to sort of a 12-month delayed completion. On top of that, you have the sort of lag on it being registered with HMLR. So actually, you could be more than 3 months ahead of the transparent data, which the general public are aware of. So two sort of crucial points there to highlight, I think, to everyone that might not be aware.
Yeah, no, I think it's a really good point, and I think that, just to add to that is that one of in most sort of non-prime markets, if you're looking at sort of data on the land registry, so for example, if you're looking at flats generally are outside of central London, apart from a few exceptions, are generally around the same size. They tend to be sort of smaller, whereas in central London, a studio flat can be anything from a 150 square foot shoebox up to a 3,000 square foot loft. And so being able to drill into the data more with use of pounds per square foot analysis really sort of gives you the edge, rather than just comparing the sold price, because obviously you could be talking about a converted broom cupboard or the whole sort of the top floor of a warehouse. So that it's really important for us just to have that sort of extra information.
Yeah, I mean, out of interest, Marcus, one of the questions that come through is what percentage of those deals don't complete? I mean, you could probably give us a view over 5 or 10 years.
Yeah, I mean, it's generally in terms of, between exchange and completion, pretty much everything. There's a few exceptions, but between under offer and exchange, I would say probably at least a third of properties that we see going under offer in a normal market will fall through for some reason. It has been slightly higher this year. I mean, what we tended to see was we saw fall through rates really spike at certain key points. So when we went into lockdown in mid-March, the week after that happened, we saw a real spike in fall throughs, both for sales and for lettings, of people just deciding that it wasn't the time for them and they'd pull out. And then actually it settled back to the sort of normal levels that we'd see. And interestingly, again, when the market opened up, we again saw a spike in fall throughs. So probably in those weeks, you'd see maybe sort of half the volume of under offers falling through, because I think people suddenly realised that we're coming out of this, and the deal that I'd kind of been I put on the back burner and been thinking about, I need to do something about now. So we do see those spikes, but generally I'd say sort of it's between sort of 30-40% of deals that we see go under offer do fall through, and for numerous reasons really. And I think that the challenge at the moment, I mean, it's settled down again a little bit now, has also been that, firstly, a lot of people after the market opened up thought that they could get an absolutely incredible deal from the seller, so they were offering much.
Sorry to interrupt, Marcus. That's one of the next questions. Is what was the difference, the reneg position, or the difference between asking price and selling price through this period? So I know that's where you're going to head now, but that's one of the key things that people want to understand.
Well, I mean, interestingly, so what we tend to measure is over time is the difference between the initial asking price and the price that someone pays for the property. So the price that they ideally wanted when they first put it on the market and what they eventually get for it. And at the moment, it's running at about 8%. So it's about an 8% reduction off the initial asking price. Interestingly, at the same point last year, it was about 10%. So it's down on where we were a year ago. But what we did see is during lockdown, people were trying to keep deals in bed, if you will. So people who'd negotiated pre-lockdown went back to the person they were buying from and said, I'm really keen to do this deal with you, but I need a kind of a bit of a COVID buffer within this deal. And so we were seeing people negotiating somewhere between 2 and 5% off over that period. But actually a lot of sellers just said no. And some of the fall throughs that we saw were because of a stalemate over that renegotiation. And I think that, the issue that we have in central London, and actually something that helps to support prices, is that very few people need to sell. There's very few forced sellers. So if people are going in and trying to negotiate a 10% discount from where they were before, the vast majority of vendors are just going to say no. So, they might give a couple of percent just to keep things moving and go through with the deal. But actually, we've not seen really significant discounts on much. I mean, there's always a couple of sort of stragglers and outliers of people who are desperate to get rid of things. But generally, actually, we've seen very little negotiated off.
I mean, we've had situations, and we've mentioned this in previous shows, where someone's been cheeky and tried to renege. The vendor says, listen, I'm not interested in that. Put it back on the market and then got a higher price. And I think that just shows currently the robustness of the residential space. It's quite surprising. I think it's surprising to many, especially a lot of the people on the call are in credit or risk or sanction or sales. And at the end of the day, I think they would have been fearing the worst. But, what's our write down? 5, 10, 15, 20%? What are we looking at? And when we started reporting, well, actually, things are a bit flat. And maybe it's 1 or 2% down here and there, or 1 or 2% up for some reason. And that was just a complete surprise. What's your view on that?
Yeah, I mean, I think that, a lot of people assumed that, in these sort of uncertain markets, it's very easy to look back at what's happened before. And I think a lot of people automatically assumed that this was the financial crash of 2008, when we saw 20% wiped off prime central London values within the space of probably 9 to 12 months. It was a rapid fall, and actually a pretty rapid recovery afterwards. But I've always been of the view that this is not like that. And that period, it was coming off the back of some pretty significant growth in prices across prime central London. We were seeing sort of double-digit growth every year for the sort of the 3 or 4 years before that. And so we're in this sort of situation where prices in central London have dropped back since the peak in 2014 by about 15% already. So there wasn't this sort of sense that the market was overvalued as we went into this. And actually, the first quarter, before we got locked down, the market was really strong. We were seeing prices increase, transaction volumes were up, a lot of new stock was coming onto the market, and a lot of people were seeing value in central London. Obviously, no one really anticipated the impact of COVID, but I think we're in a strong position coming out of this because people saw that central London appeared to be a good investment, and I think they're seeing that again. And obviously, everything that the government are doing to support the housing market just gives them that bit more reassurance that the government's got their back, if you will, and that they want to support a fully functioning and successful housing market. And I think that's adding a lot of confidence for people.
Agreed. And to reference one of the points you've just been making, every week on the show, people have been asking what's happening with the trend of people moving outside of London to either Greater London or the suburbs or the home counties. What is the trend of people looking for outdoor space, and how has that changed? What have you got in those 2 points for us? Because it's a question that just repeating and repeating.
Yeah, it's a really interesting one, because I think that if you read some of the newspapers, you assumed that everyone who was looking for a property in London was now looking for a house in the Cotswolds instead, and I don't think that's the case. I think that what it has done is, I think that people have realised the importance of where they live, and part of that is outside space, obviously, because during lockdown, people who didn't have outside space sort of struggled with the fact that they were only allowed out an hour a day, and so I think that it will have an impact on property in London without outside space, undoubtedly, over the next few months. Also, partly because it's summer. I mean, it's sunny here today. It hasn't been for the last few weeks, but it's summer here, and actually, most sort of summertimes people will look for properties with outside space because it's warm and that's what they want to do. So I think that sort of properties with outside space or access to green space will be in quite high demand, both in London and elsewhere. There will undoubtedly be people who were looking in the sort of inner suburbs of London because they needed to travel into an office 4 or 5 days a week, that now might not need to do so we'll be looking further afield. But personally, I think that that doesn't impact the central London market quite so much, and particularly if you're looking at sort of the West End and towards the west and southwest of London. London is one of the greenest cities in the world in terms of green space. So actually, it might be that just getting access to Hyde Park might be enough for someone. So
that's a really important point, and we're seeing lots of transactions in Belsize Park, in Hampstead, St John's Wood, Regent's Park, all of these areas that are, as you've just said, surrounded by green spaces where you're living in one of the most densely populated cities in planet Earth, and at the same time you're living in a village with parks and lakes and cosmopolitan lifestyle and outdoor dining, etc., etc. So you're living in a village, but in a major city. And so the trend we're seeing on the ground, actually, the demand in those areas good, in core and prime. What about super prime? Because we saw a lot of big deals go through during lockdown and post lockdown, which again, many were surprised, some really big ticket 10, 20 million plus transactions. At the same time, the Mayfair, Chelsea agents are saying that the volume of both instruction and property inspection and viewings is down because some of the people can't get back into the country because they're going to get quarantined. So tell us a bit about that space.
Yeah, well, I think that what's important to understand about sort of the central London market is the more expensive the property becomes, the higher the proportion of buyers that are overseas buyers. So if you're sort of talking 5, 10, 20 million plus, the proportion of overseas buyers in those sectors, you can get into a position where there's 2 overseas buyers for every 1 domestic buyer, and I think that it would be naive to think that the current sort of travel restrictions won't mean that fewer of those people will be around to look for property in London. So I think that those markets will probably be quieter until travel restrictions open up and people can come across. There have been some examples of people buying things with buying agents over FaceTime or Zoom, but I think they are, they're quite sort of isolated cases, and the majority of people, if they're spending 10, 15, 20 million pounds in London, will probably want to physically view what they're buying before they buy it. So I think that market might be quieter. On the flip side of that, I think that central London has always attracted investment in times of uncertainty, and I see no reason for that not to happen again. With everything that's going on in Hong Kong, for example, and the strong links between Hong Kong and the UK. We could potentially see people wanting to invest in central London because of the precise fact that the global economy is slightly precarious at the moment, and it has been a good place to store wealth in the past. So it's a difficult one.
I think that's a really important point, that to put context and have a macro outlook. Historically, whether you're in gold, bonds, US dollar, and prime resi in London, that market has been seen as the safe haven because the demand and supply equilibrium works, the legal system and the transparency in data and information works. It's a trusted marketplace, and that perception allows global wealth to come in. What we're looking to see is if that 25, 30-year trend continues with this pandemic. Is that fair, Marcus?
Yeah, I think so. And it's very easy when something changes within the market to assume that all of the old rules disappear and we're sort of going into this brave new world. And actually, a lot of the decisions that the world's wealthy are making are, will probably be similar to the decisions that they've been making over the last 20, 30 years in terms of spreading the risk, tangible assets that they can use, and prime central London has taken advantage of that because it ticks quite a few of those boxes. I think it's and also worth remembering that there is the stamp duty saving at the moment until the end of March. Obviously it makes a higher difference percentage wise if you're buying at 500,000 than if you're buying at 50. But also that there's additional taxation potentially coming in April next year for overseas owners. So it could push some overseas buyers into buying something before the end of March, just because there is a bit of a saving there for them, particularly if they're not buying at that super prime end of the market. If they're buying something at £1 million, say, for their child who's over here for school, the savings with stamp duty and taxation before then could make sense. So we could see some of them coming across. I think it's unlikely that we're going to see the volume coming over, and particularly the Middle Easterners often come over here in August to escape the heat, and whether they'll be doing that in such significant numbers this year is probably likely that numbers will be down. So those people won't be spending on everything, not just property. So I think it's going to be a challenging time, but I think we shouldn't sort of forget the importance of prime central London within people's portfolios, and I don't think that's going to change.
Yeah, I think you've touched on a good few points there that leads us to James, and we can maybe look into some of the government incentives and touch on that. That's where quite a few questions are coming through at them.
Yeah, so just to update everyone on more macro property market news, obviously there's been these announcements in the last week or so of some planning reforms, quite major planning reforms, larger than we've ever seen before, really. There's been some loosening rules on brownfield sites, which is obviously going to enable those more major house builders to deliver more homes to the market, as there's obviously pressure to get those figures up, especially after we've had that 3-month lockdown where there's been heavy delays. There's been more prior approval, more permitted development rights, which is going to possibly enable more office to residential conversions. And also there's been further changes to some domestic homeowners, which will have greater ability to extend their homes outwards or even upwards, subject to obviously agreement building regulations and some other rules and regulations. More news in terms of help to buy, which has been at the forefront of the property market since it was introduced in 2013. This is going to be extended until 2023, we understand. However, it's going to be more restricted to first-time buyers and only applicable on new build homes. And I think that's maybe quite a good place for us to start with the question. And in your opinion, has Help to Buy been a linchpin in propping up the London and UK property market in the last few years?
I think with Help to Buy, I've got slightly conflicting views on Help to Buy, because I think that it's certainly helped people to get onto the housing ladder, and to be honest with you, more outside of London than in London, because the price thresholds, particularly for central London, of I believe the highest it went to was £600,000, and a lot of areas of central London you would struggle to get much, particularly on the new build side, for under £600,000. But outside of that, it has helped quite a lot of people get onto the ladder. I think the difficulty with it is that it has become a bit of a cash cow for developers, and you could argue that it has pushed the price of new build properties outside of London, or in outer London, up, because it's just given those people more buying power, and there could have been maybe a slightly better way to do it. But I think that they've probably done the right thing in extending. It was due to end, and they have extended Help to Buy, because at the moment I think they need to do everything that they can to try and sort of get people out there and spending money and transacting. So I think that it's the right decision. Could there have been a slightly better approach to Help to Buy? Possibly, but I think it's certainly welcomed at the moment in terms of getting those people out there and enabling them to buy something.
And it brings activity to the market, I think, and that sort of real sort of multiplier effect, which sort of ripples through the economy, from construction to agents to really sort of to placemaking and new sort of neighbourhoods. Really, I've got a few more questions on Help to Buy. I mean, one sort of lingering question is, should the government continue to effectively sort of subsidise the market? And really, how is the government going to phase out Help to Buy? As this scheme surely isn't particularly sustainable in the long term, especially after we've just seen them extend the scheme.
Yeah, I mean, I think they're going to have difficulty in sort of phasing it out and what they do, because I think the real challenge with the housing market, and obviously this is without my sort of prime central London hat on, this is sort of more of a general sort of UK market. The big challenge for anyone who's trying to get onto the housing ladder is deposit. And there's a lot of people out there who could easily service a mortgage, but they can't. They're not in a position to save up 10-15% of the property's value to get onto the ladder. So they're sort of stuck in this sort of situation where they could afford a mortgage, they're paying rent, but they just can't build up that deposit. So possibly doing something that's rather than giving a slightly sort of complex subsidy through Help to Buy, is doing something where there was some sort of government guarantee on sort of some element of the deposit, because I think that's the real challenge, and it's something that that Help to Buy has tried to remedy, but I think they're going to have to look at that going forward. I mean, I'm thinking when I bought my first flat 15 years ago now, I bought that with I think it was a less than a 5% deposit, and the banks were desperate to give me 110-120% mortgage, and I certainly don't think we should be going back to that, but something between the two I think would be a good position to be in.
Yeah. I think that leads me on quite well to the next question, actually, and basically the whole Help to Buy scheme effectively relies on steady house price growth, which, to turn it on its head, in turn sort of worsens affordability for those, again, at the bottom looking to get onto the housing ladder. And I think that's one of the main challenges. And how do they overcome that?
I think it is giving them a leg up in terms of having some kind of solution for that deposit. I mean, I think we've got ourselves into a slightly difficult position in the UK, because interest rates have been at sort of historic lows for quite some time now, which has meant that it's a bit like if you buy a car now, you don't really look at the actual price of the car, you look at what your monthly payments are going to be. And I think it's a similar thing with the housing market, in that actually we've interest rates at historic lows for quite some time. House prices have gone up quite significantly over the past 20 years. And so we're in a position where people have houses that are worth a significant amount of money, and obviously people, the last thing the government wants to do is for house prices to drop significantly, because all homeowners aren't particularly going to like that. but it's sort of enabling people to get onto that ladder, and also it's about maintaining prices. I mean, I think that houses aren't necessarily somewhere just to live now. They're a significant store of wealth, and that store of wealth, it's my sort of view of it is that actually the housing now is viewed by the government as a kind of an enforced savings scheme. So by the time you get to retirement, you've probably paid your house off, and if you live in a relatively expensive area, you're sitting on probably at least £500,000 worth of cash that you can access over time during your retirement. So I think that they're not going to want to see house prices drop significantly because it's that store of wealth that people need. But the other end of that is making sure that you can get new entrants to the market without the help from mum and dad, and that's I think that's going to be the challenge. And I'm not quite sure necessarily how they're going to do that, but I think some sort of deposit guarantee is possibly the best way to do it.
Yeah, I mean, sorry, Rob, you go ahead.
Yeah, I was just going to say, some of the questions that come in and some of the concerns relating to that. See, you've got your stamp duty, holiday, you've got your Help to Buy, you've got the planning reforms coming in. And these are all stimulus to keep the market moving and create activity. But the concern is, does this then create an artificial bubble? And are we going to see January, February, March, or April of next year, this stimulus has run its course, or does it force the government to have extensions to all of those offerings because they won't be able to turn them off, because turning them off will be so detrimental to the market that they won't be able to afford to do it. So what are your views on that?
I think they were gonna, if they do take it back to the levels that we were at just a month or so ago, I think they will have to do a phased return, because I think we certainly see within our data. So, for example, when the additional rates came in for second homes and investment properties, we saw a significant spike as people rushed to get deals through before that, and then the market dropped off afterwards. And I think that the challenge is going to be is that everyone's going to try and push deals through before the 31st of March, and then anyone who is transacting after the 31st of March probably will have to take the equivalent of the stamp duty off the price that they're going to get for their property, because people are going to want an incentive to transact. So I think they're going to have to taper it.
Sorry to interrupt. My gut feeling is that that's just not going to happen. They're going to have to extend it. They're going to put themselves in a position where they want there to be continuity and sustainability in the market and a good flow of transactional volume. And the danger of pulling it back or phasing it or revoking it will be so great to the wider economy that I'm not sure they're going to be able to do that. And so what I believe is that they're putting everything into the housing market and trying to get it moving. And what's going to be the key requirement is that employment is then going to be the key. People in January, February, March, April next year will need jobs. They will need jobs to ensure that they're either buying or renting properties and they're making their repayments. And for that whole food chain, property chain, economic chain to function and work, employment and the property market are going to be key, and they're going to work together.
Yeah, and I think that's the big sort of elephant in the room here. Actually, is the state of the economy and the state of the the levels of unemployment that we're going to see, because this whole everything that we're talking about relies on people well sort of having a job to be able to secure a mortgage to buy something, or being confident enough in their job security and the state of the economy to transact. And I think that is going to be the big challenge going forward, particularly after we see flexi furlough ending sort of in the latter part of the autumn. And I'm not quite sure, there's the government incentive of I think £1,000 if you've still got someone in employment by January. I personally don't think that's going to really change too many employers' minds if they are going to have to get rid of someone. So I think that's going to be the real challenge going forward, is making sure that the economy is in a good enough state to sort of enable the market to to continue to be successful, and that's going to be the real challenge next year, I think.
Definitely. James. James is frozen. Okay, so favorite question for everyone in the market. Marcus, hotspots. What have you got for us? Give us the hotspots. It's everyone's favorite question.
Well, I mean, I think that outside of London first, and then I'll move to London afterwards. Outside of London, I think it's possibly properties that are slightly beyond what previously would have been seen as an acceptable commute. So I think that, we were talking earlier about, it's not everyone's going to look to leave London, but there will be some people who, their work patterns have changed and possibly looking at moving, say, a train journey that's an hour and a half away from London, if they've only got to come into London 1 or 2 days a week. So I think that could be a trend outside of London. So maybe some of those more affordable areas that previously were a little too far away and now could sort of be doable on a couple of days a week. In London, actually, sort of going back to what we were talking about before, in areas that have a village feel, that have access to green space, and possibly where you can get to work not on the tube. I think sort of Notting Hill is always the prime example of somewhere like this, that it combines enough green space to feel like you can breathe. It's got enough locally that you can go out for dinner in the evening in the area. There's lots of choice, but also you're close to the office if you need to be. And I think in London, those kind of locations will do well. Possibly somewhere that's a little bit more built up, on the third, fourth, fifth, sixth floor without a balcony will struggle. But I think it's those sort of London villages again which will do well. The other trend I think that's worth looking at is whether people swap their central London property and their country property, in terms of, we've got quite a lot of people who've got a decent sized property in central London and then a smaller cottage in the Cotswolds for weekends, and whether they swap that round. So they buy a smaller property in London for when they're in London and a larger property in the country. So, but I think that certainly for London, those sort of villagey locations, that if you drive around central London at the moment, the areas that are busiest are those where there is, a resident domestic market. If you drive around Notting Hill or Chelsea, it's a lot busier than if you drive around Belgravia or Knightsbridge at the moment. So I think those areas are probably the ones to watch.
And last few minutes for questions to come through. Deal flow, pricing, values, risk, lending, product, valuations, affordability, commercial, residential. Any questions you want on those areas, please get them in. Marcus, a few questions are coming in relation to buy-to-let product and the rental market, how it's been affected, the trends that we're seeing, slightly different to historic trends in downturns. Give us your latest view on the rental market.
Yeah, I mean, actually, unfortunately, the rental market is sort of quite a stark contrast to what's happening in the sales market at the moment. And the rental market in central London is very reliant upon supply and demand. So it's all about the balance between the two. And what we saw over lockdown was that new instructions in the sales market dropped by 85%. So very little was coming on for sale. In the lettings market, it did fall back, but we only saw about a 30 to 35% drop in the number of new lettings listings over lockdown. So as we came out the other end, there was a lot of stock. So just to give you an idea, the number of properties that are on the market now to let compared with the same point last year, we're about 50% up in central London. So there's a lot of choice, and tenants realise that they're looking, that where they would have been looking at 10 flats, there's sort of 15 to 20 possibly in their area that are suitable for them, and they're negotiating pretty hard. And so we've seen rents drop in some areas by about 10% on the same period last year. So it certainly is a challenging market at the moment, the rental market. Also, there's fewer people who need to be in London, central London at the moment, and they are, a key demand for rental property in central London. Similarly, overseas students, the number of overseas students who rent actually pretty pricey flats in central London is quite high, and we're expecting at least probably a 50% drop in overseas students physically in London for the next academic year. So demand levels have dropped back. So I think that the rental market is one to watch over the next few months. Encouragingly, we have seen that stock is slowly being absorbed. So it is a little better now than it was certainly sort of 6 to 8 weeks ago. But I think that we're going to be in a position where there's going to be quite a lot of choice for tenants, certainly for the next month, possibly 2 months, which could lead to some further falls. Because for landlords, what they really want to avoid is a void rate. So they're happy to accept lower rents just to get someone into that property, and so we are seeing them fall back.
I think what's really, really interesting, what we're seeing is we're seeing a tremendous volume of HMO action, which doesn't happen in the core prime central London, just secondary markets. And so the entry point for the rental market is lower because you've got obviously multiple occupation. Investors are loving that space at the moment. The product is good. There's quite a lot of competitiveness in the marketplace, and we'll go to James in a second. He'll give us some product and pricing update, but we're seeing really strong demand in the HMO and the investment market for that space because that product is secondary and happens outside of central London predominantly. James, what have you got for us on product and pricing?
Well, those lenders which specialise in the HMO market are still ever present, but just a quick update on sort of the more prime end. Accord has recently increased its maximum loan size from 1 million up to 2 million, and that's on new and additional loans, with the LTV now available of up to 85%. Just to give you some rates, so a loan of up to 2 million, 85% LTV, their 2-year fixed rate is 2.75%. However, this drops significantly if any loans below 80% LTV have a 2.33% 2-year fixed rate. So a bit of a flavour there on facilitator and enabling finance for those who are actively looking to move into that market and acquire property.
Great, thanks, James. Next question. Are we going to see a change in trends relating to the size of property that people are looking for? So historically, in the last crash, we would have seen the reduction of floor space, especially for flats. So you would have gone from 3 to 4 bedrooms back down to either studios, 1 beds and 2 beds. That was built around stamp duty and obviously getting as many properties in so that the price point was more affordable for the mass market, and the same with the house market. So do we expect any changes in those trends?
Are we talking in terms of new build or just generally across the whole market?
Both in new build and in buyer demand and trend in what they're looking for.
I think interestingly, with so many people spending so much time in their properties during lockdown, I think that the demand for quality of space is going to increase. So everyone has been able to identify everything that they dislike about their property over lockdown, and I think that's going to move through. So I think that actually it's going to be quality of space, and what we've been seeing is that sort of the real best-in-class properties have actually been in very, very high demand because people don't want to compromise as much over certain aspects because they've realised that a basement flat with very little light is not a very nice place to be in if you're not out in the office for 12 hours a day. So I think that's going to potentially shift, and we might see a demand for better quality product, certainly in prime where people can afford to be a little bit more picky. On the new build side, I think that will, interestingly, what we've seen over the last few years with fewer investors buying, certainly overseas investors buying into some of the new build developments, is that possibly they will have to look at more of a variation in the types of properties that they have. Previously it was very much, it was a certain size of one bed that stacked up for the rental market, and a two bed, two bath, were the sort of the stock flats that they put in everywhere. And so I think that we could start to see a little bit more variation within these blocks, because they're thinking that, if the investor market drops back, then we may have to try and appeal to the owner occupier. And so by sort of building a greater variety, potentially they could do that.
Great. Anything else you want to add, James?
Well, it's just a sort of a food for thought, maybe, with the sort of availability of investment stock and build to rent, as we said. Is there going to be sort of a new trend of long-term renters in the market who that's their sort of aspiration, to have sort of good quality, affordable accommodation, or maybe more longer-term contracts?
Possibly. I mean, I think that there is a culture of of home ownership that's going to be quite sort of difficult to shake. And it's certainly the UK market is very different from somewhere like Germany, where actually long-term rental is the norm in a lot of particularly also the cities. But I think that there is nothing wrong with offering people a more secure tenure. So I think that some of the difficulty with the rental market as it stands in the UK is that landlords have been able to ask tenants to, or force tenants to leave properties with relatively short notice if they want to get someone else in, if they want to sell, and so it has made it a bit more of a transient market. And so I think that if there were those sort of tenancies on offer, I think it would be a good thing. And I think that the build to rent market is probably best place to do that, because they are tending to look at long-term investments, and they can allow people possibly, one of the big things in Europe is, if you rent something for the long term, you can, redecorate, you can do what you like with the property, and as long as you return it back to the state it was in at the end of the tenancy. And obviously that makes people feel a lot more like it's their own home, rather than sort of, not being able to put a nail in the wall to hang a picture. And so I think that, it certainly would be a good thing for the market. Whether I think that it would change anything within sort of the psyche of the majority of people, in that, they do eventually want to own something, I'm not quite sure. But I think that flexibility is certainly not a bad thing.
To throw you on the spot, Marcus, are we going to see sustainability in the market? I think it's going to move on in 2021, or is this a bubble, and is there a cliff waiting for us?
I don't think there's a cliff waiting. I think that this year, because of all the government intervention, is probably going to be better in terms of prices and activity than most people would have expected a few months ago. So I think a few months ago everyone was expecting that prices would be down at the end of the year, and transactions would be significantly lower than we'd normally see in the sort of a similar 12-month period. But I think that the government stimulus will definitely help that. I think that the challenge that we talked about earlier is going to be the state of the economy and the employment market next year. So we could potentially see a little bit more of a challenge market next year. But I think that what's really important with central London is that we've got to remember that it's a market where there's very little debt held against central London property. Most people either own cash or own it predominantly with equity. So it's not a market that has a huge amount of debt secured against it, and it's a market where the holding cost is pretty low. I mean, you're talking council tax, and that's pretty much it if you want to hold a property in central London. So it's I think that for those people, unless something disastrous happens to the economy, I kind of see it being slightly shielded from further significant falls. It might fall by a few percent next year, but I don't think we're going to see a situation like 2008 where we see values drop off a cliff. I think it's going to be potentially a slightly challenging market next year, and then possibly, hopefully, a bit of a, a return to sort of sustained, relatively low level growth, because, no one really wants to see double-digit annual growth, because it just leads you into a bubble. So I think if we can see sort of sustained, few percentage point growth per annum from sort of 2022 onwards, I'd be pretty happy.
Brilliant. I think, listen, one of the key messages that I keep on repeating and repeating is that uncertainty in global markets is absolutely the new certainty. Uncertainty is the new certainty, and the property market needs to be able to manage peaks and troughs within uncertain market conditions. And there is a certain robustness that we're seeing at the moment. And yes, because of stimulus, but still there's a certain robustness that we're seeing in the housing market. And the key question is going to be, how sustainable is that? And what does 2021 look like? For that, I can assure you, with support of Lonres and Marcus and his great team, we will continue to provide you with the latest information, the latest data, what is happening on the ground. We will take you on the journey on a weekly basis and give you all of the information. Thank you so much, Marcus, for being with us. Thank you, everyone, for your amazing questions. Thank you for turning up week after week after week. I'm sure you'll agree, we're hopefully providing great content, great added value, live information for all of you in lending and banking, to make the decisions that you need to make to ensure that you're able to provide the best service for your client base and to make the best risk or sales decisions within your team. We will be back same time, same place next week. #Askrobco. Thank you, Marcus Dixon from Lonres. Thank you, James. Thank you, Dan. Thanks for the team. And thanks everyone for listening. We will see you all again next week.
Thanks, Marcus. Thanks all for tuning in.
Thanks. That's great. Thank you.